Hello, let us discuss in section 13 the exchange rate determination and forecasting. In this section, we will be discussing about various theories of exchange rate and how the theories along with different parameters determine the exchange rate and how we can use this parameter in forecasting exchange rate. If you remember in our earlier section, we have discussed interest rate parity hypothesis, we have discussed the forward premium, inflation, interest rate, all variables linked together and determining a complex process where exchange rate can be forecasted, and this variable in a systematic way describe about the near future exchange rate. We will be using this variable along with various others macroeconomic parameters to forecast exchange rate, and also we will be discussing about the relevant theories of forecasting of exchange rate. The theories here primarily the asset market theories, the interest rate parity hypothesis theory, and also the monetary approach to interest rate modeling side. Let us start with the focal point of discussion of exchange rate. Here the prime focal points are parity condition, the balance of payment approach, and asset market approach. These are some competing theories, but they are complementary to each other. Rather, we can use the word complementary, not competing. In parity condition, we have discussed the interest rate parity, the inflation parity, and how interest rate along with inflation determine the near future spot rate. We will be further analyze this concept. In the balance of payment approach, you know the export, import, the inflow, outflow of a foreign exchange determine the demand and supply condition of foreign exchange, and along with the domestic currency, the inflow, outflow of foreign currency determine the value of the currency. The balance of payment is the starting point of demand and supply side. In export import current account side, that is export import invisible inflow outflow, they determine the current account deficit or current account surplus, along with what is called the large long run inflow outflow, particularly the our capital inflow, gold import, gold export, capital inflow, FDI, FI, they determine the capital account convertibility side and capital account deficit or surplus side, along with the current account deficit and surplus and capital account deficit and surplus determine the level of demand and supply of foreign currency in a domestic economy. If the demand is more, supply is less, it leads to depreciation of the currency and finally reflect a positive or negative side of current account deficit, which may pull the exchange rate either in the towards depreciation side or towards appreciation side. Asset market approach, we consider the foreign exchange as a asset and people demand the foreign exchange for investment side, and this asset market approach also help in determining the foreign exchange rate or some extent help in forecasting the near future foreign exchange rate. These are basic focal points, focal theories of fundamental theories of what is called interest rate determination, exchange rate determination, and this theory we cannot mention them or cannot consider them as a competing theory, because not a single theory will be in a position to forecast the exchange rate in actual manner. So, rather we can consider this theory as complementary to each other and describe the near future spot exchange rate in a systematic way. Another side of the also the real market side. Real market state, particularly our real demand and supply of foreign currency. Here we can mention about the growth center. Growth center means there are many emerging economies are there, they are the growth center in a world economy. This economy demands more foreign currency because they are growth center that needs foreign capital or foreign investment for their development of their economy. And towards this country or to foreign exchange either in the form of portfolio investment or in the form of foreign direct investment inflowing. And this large scale inflow of foreign currency to this emerging economy, particularly India, China, Brazil, these are the emerging economy where the demand and supply of foreign currency though very high, the supply deficiency may sometimes create some kind of depreciation of foreign currency, foreign exchange rate, and also at the same time they have large scale inflow of foreign currency which may sometime influence or appreciate the domestic currency and create some kind of problematic aspect to this country. So, we can use some extent the real sector phenomenon to describe the foreign exchange determination. At the same time, financial liberalization after 1970s or early 80s, many countries liberalized their economy, particularly emerging market economy, they liberalized their economy. They liberalize in economies in the sense that they open up their economy, they allow the export, import, foreign capital, foreign inflow and towards their own economy. And this liberalization help in some extent inflow outflow of foreign currency and which lead to depreciation or appreciation of foreign currency. So, international financial liberalization or integrating the domestic economy with the world financial system some extent also influence the depreciation of domestic currency. Similarly, political instability, political sovereign risks, political instability, stability of some extent also influence the foreign exchange inflow outflow, which may be considered as a parameter for the determination of exchange rate. Let us discuss about the various theory in a systematic way so as to articulate how this theory can contribute in explaining the foreign exchange rate determination or exchange rate forecasting side. So, here determinant of foreign exchange rate, particularly the parity condition we will be discussing, and asset market approach we will be discussing, also we will be discussing about the balance of payment in details. In the parity condition, so we understand the parity means here interest rate parity, parity means here inflation side, parity may be because of preference of people. So, it may happen that inflation in a particular country is very high. So, real interest may decrease, real interest may come down, and this may lead to outflow of foreign currency, because when the interest rate differential, it is a source or a determinant of foreign currency inflow outflow. In our interest rate parity hypothesis, we have discussed how interest rate between two countries create interest rate differential, which lead to outflow or inflow of foreign currency. When here we will be discussing about suppose Indian interest rate and US interest rate, here we can last class we have discussed in our session 12 we have discussed about interest rate parity hypothesis in a systematic way. Suppose interest rate differential in US minus interest rate in India, there exists some differential because here it may be positive or may be negative. So, it may be anything positive or negative. Suppose interest rate in US is 4.25 percentage and interest rate in India is 8.25 percentage, there exists a difference of 4%. This 4% differential, because Indian interest rate is high, it leads to inflow of foreign currency, particularly US dollar to Indian economy. Why it is so? Because Indian economy is a investment side now, because the Indian economy is giving more interest rate. So, interest rate differential create some kind of impulse in the inflow of dollar to a particular country. We have discussed that earlier classes, the future spot is nothing but current spot into 1 plus domestic interest rate divided by 1 plus foreign interest rate. We have discussed this phenomenon last earlier classes, that this you want to forecast the near future interest rate, the near future interest rate primarily influenced by interest rate parity. Interest rate parity means the parity, if there is no parity in interest rate, that means there is a differential between two country interest rate, the differential create a impulse, create a force for the inflow of dollar or inflow of foreign currency to a country where interest rate is higher. This interest rate arbitrage creates some kind of arbitrage profit, and this leads to the flow of the foreign currency to a domestic economy. So, generally in India interest rate is higher than US in United States, so there is a flow of dollar to India, because India we consider as a investment market. So, this interest rate differential is some extent influence the exchange rate inflow outflow. We have discussed in earlier classes that interest rate parity hypothesis, there are 3 different kind of parity hypothesis. We have discussed the first parity hypothesis, parity, why parity exists. The parity exists because parity is supposed to be existed in real market, because the traders in foreign currency are same, they are also playing in a US market, same players are there in Indian market. When they see a interest rate arbitrage available in India and US, they buy, if the interest rate is higher in India, they invest in India by borrowing dollar from US, and in this process they get the arbitrage. So long as the arbitrage opportunity available in interest rate differential, there will be inflow outflow of dollar. So, arbitrage opportunity sometime may be considered as a determinant of exchange rate. So, we have discussed last class that earlier session, the interest rate in India minus interest rate in US, that is domestic minus foreign interest rate, if it is positive, it will lead to 3 different kind of theory. First theory is this interest rate may lead to what is called forward premium or discount or forward discount. It lead to may what is called a appreciation or depreciation of domestic currency. And third is that if this may happen in what is called a real interest arbitrage, real interest arbitrage. So, this forward market, because when there is a differential interest rate is positive, the differential interest rate adjusted in forward premium or forward discount. If the interest rate is differential interest rate is positive, the currency, domestic currency will be depreciate, or domestic currency will be a forward discount currency, and here in the spot rate you have to add the forward discount. So, here this way spot rate you have to adjust the forward discount. This theory is telling that. Second theory is called if the interest rate is positive, it may happen that the trader will borrow from US market in dollar, convert the dollar into Indian rupee and get higher interest in Indian rupee, and this way there will be more flow of dollar to Indian economy. When more dollars are flowing to Indian economy, the dollar will be converted into Indian rupee, there is more circulation of Indian rupee in the economy. This lead to depreciation of Indian currency, and the depreciation adjusted in the future spot rate. So, currency will be depreciated, dollar will be appreciating currency, rupee will be depreciating currency, these two are adjusted here. Similarly, because we are not nowhere factor the inflation here, because these interest rates are nominal interest rate, here we are not factoring the inflation. We discussed in the earlier session nominal interest rate minus inflation, it is the real interest rate. It may happen the difference in nominal interest rate is available, because inflation in India is very high compared to US. So, if you factor the inflation rate, it may happen that this gap between India and US interest rate will be reduced further, because the inflation in India is higher than the inflation in US, and this way we are discussing about real interest rate arbitrage. Real interest rate arbitrage between India and US is quite low, because if you at present consider Indian interest rate something around 8.5 percentage and US interest rate something around 4.25 percentage, the differential is 4.25 percentage. The 4.25 percentage is the real nominal interest rate. However, if the inflation in India is something around 8% and US inflation something around 4%. So, the difference in inflation is 4%. So, nominal interest rate difference is 4.25, real interest rate difference is 4. So, inflation differential is 4. So, actual real interest rate differential is 4.25 minus 4 is nothing but only 0.25%. The real interest arbitrage is very low if you adjust the inflation between two countries, and actually you have to factor the inflation whenever you are considering something around more than 6 month period of forecasting. Short run forecasting may not required, but long run forecasting you have to adjust the inflation differential also. The interest rate parity hypothesis explained to us that the future spot rate is a function of current spot, interest rate differential, and inflation differential. So, what does it mean? The future spot rate has a primarily 3 aspects taken into account to determine the future spot rate. You have to take into account for future spot rate for forecasting the current spot. You have to take into account the interest rate differential, and also the inflation differential. So, the current spot, interest rate differential and inflation differential may give some kind of prediction, some kind of near future prediction about the future spot rate. This is a primary thing interest rate differential take into account, and the interest rate parity hypothesis address these 3 concepts, the current spot, interest rate differential and inflation differential to determine as the future spot rate. So, primary determinant for future spot rates are current spot, interest rate differential and inflation differential, that we came to know from the interest rate parity hypothesis. So, parity hypothesis primarily discuss the inflation rate, the relative interest rate and interest rate parity. These 3 aspects take into for interest rate parity condition, which provide some kind of basic or fundamental aspect for the prediction of exchange rate. Third, this parity condition we have discussed. The second aspect is here asset market approach. Asset is here because when you consider asset market approach, the primary variable also here the interest rate, the prospect for the growth asset market. If the market is growing, there is a prospect for the growth. So, it may happen that there will be more flow of dollar, more flow of foreign currency to that economy, and that economy is expanding. So, it means that economy may demands more dollar and domestic currency may depreciate. In that aspect, asset market approach some extent the growth parameters also influence the demand and supply condition of the foreign exchange, and it is also some extent near determinant of foreign exchange rate. The supply and demand for asset, suppose the dollar is more demand, there is so US dollar is more demand. So, supply there will be more, since supply is less, the US dollar may appreciate, and against the Indian rupee, the rupee may depreciate. Similarly, outlook for political stability also, suppose the asset market, the growth in the asset market are also influenced by the demand and supply condition and also political stability of the country. Sovereign risks, political stability also influence the exchange rate. Then speculation liquidity. Speculation means some extent the speculators also determine or influence the exchange rate, but very short run. Long run may not influence, but short run the liquidity, the demand and supply condition, the speculation also influence the exchange rate. The political risks and control aspect, the political risks means that is the political instability, control aspect, the economy is not liberalized economy, some extent controls are there in balance of payment, movement of inflow, outflow of dollars or foreign currency, which also influence the exchange rate. The balance of payment side, some another theory, last theory we have discussed about this, the balance of payment, the current account balance. Current account is primarily export, import, invisible, they decide the current account deficit or surplus. Emerging economy, particularly Indian economy, they always the export is, imports are more than the export. So, current account deficit always there. However, invisible inflow outflow, particularly the NRI investment, NRI inflow outflow dollars are there, this some extent gives some current account surplus. However, invariably Indian economy we have current account deficit. A current account deficit indicates there our exports are not in a position to pay for our imports, our invisibles are not sufficient to pay, remove the current account deficit. So, there is a current account deficit always there. Portfolio investment, particularly in a liberalized economy, when the foreigners are allowed to invest in domestic economy, particularly debt market or the equity market, there will be more portfolio investment, there will be more inflow of foreign institutional investment. We also help in bringing foreign currency domestic economy, that also influence the determinants on exchange rate. Third, foreign direct investment, the economy is liberalized, different sectors are open up, the foreigners are allowed to participate in domestic development, that foreign direct investment also contribute to appreciation or depreciation of foreign currency and the domestic currency. The exchange rate regime, another aspect of the exchange rate, which exchange rate we are describing or we are opening, whether our economy is a more floating exchange rate system or a fixed exchange rate system, or our central bank particularly are in determining the exchange rate, which regime means which exchange rate regime we are operating. In a floating exchange rate regime, where the intervention on the part of the central bank is very less, that may create some kind of speculation in domestic currency and also allow the more foreign institutional investment to the economy. In a fixed exchange rate regime, the exchange rate is not market determined, also some extent influence the determination of exchange rate system. So, a regime of foreign exchange rate system some extent influence the exchange rate determination process. The most important official monetary reserves, we have significant official reserve, with our foreign currency reserves are significant. It also gives stability or increase our foreign sovereign rating, and this also influence the exchange rate determination process. So, India, many emerging economy have significant amount of foreign currency reserve. This gives stability to foreign exchange market and also helps in increasing the sovereign rating, which in turn influence the foreign institutional investment, foreign direct investment and foreign capital inflow to domestic economy. These are the balance of payment side. We will be discussing separately each aspect. However, in this process, let us discuss with the purchasing power parity theory. Purchasing power parity theory is a long term phenomenon or the movement of exchange rate. We have discussed the purchasing power parity theory earlier section. Purchasing power parity theory consider foreign exchange as a power to purchase goods or the relative power to purchase goods. Relative powers mean a currency with a US dollar or Indian rupee, which is what powers or value they are having, the intrinsic value, because the purchasing power parity theory determines the exchange rate in a long run, because it gives some kind of clue or some kind of value to the exchange rate system. We have discussed about purchasing power parity theory earlier classes. We have mentioned that if a internationally traded commodity, a basket of commodity, when you purchase from different country, what rate we pay, that is that rate determine the exchange rate of international currency, because we have to find out a basket of international tradable goods and try to purchase this good in different country. On that basis of the money you pay in different countries, that will exchange, that will create some kind of exchange rate system. So, purchasing power parity theory provides us the intrinsic value of domestic currency, the power of domestic currency, and the purchasing power parity theory determine or what is the long run interest rate, long run exchange rate movements of the country. So, purchasing power parity theory is the basic aspect of interest rate parity or the parity hypothesis. Here purchasing powers are being equalized in different countries. So, purchasing power parity theory gives us what kind of formula, some kind of formula to us to determine the long run exchange rate in economy. Purchasing power parity exchange rate at time period t is nothing but exchange rate at the spot market into 1 plus the interest rate in the price. Here is the I you are using the domestic price divided by I plus international price, foreign price to the power t. Other word, currency exchange rate at time period t is nothing but spot rate into 1 plus domestic inflation here, domestic inflation rate divided by 1 plus foreign inflation rate to the power t. Here suppose t is 1 year, then current spot rate is something around 55.3030, and domestic inflation ID I put here, ID is 8% and foreign inflation I put 4%. Then you can calculate the exchange, the after 1 year what will be the exchange rate between two country. So, here you have to calculate what is that, after 1 year the rate will be E is equal to, after 1 year time period t is equal to 1. So, E 1 is equal to current spot is 55.3030 into 1 plus domestic inflation is 8% here, 8%, foreign inflation is 4% here, 1 plus 4% here, 1 power 1. This will give us the after 1 year what will be the equilibrium exchange rate between US dollar and Indian rupee, because the inflation in India is 8% and inflation in US is 4%. What does it mean here? Where, because whenever domestic inflation is higher than the foreign inflation, the domestic supply of money will be higher, and this lead to what is called depreciation of domestic currency. The purchasing power parity theory try to equalize the purchasing power or the inflation differential between two countries. So, when we use the purchasing power here, we indirectly are estimating the inflation rate. If inflation in India is higher than inflation in US, then Indian rupee will depreciate against US dollar. That is the fundamental principle of purchasing power parity theory. Here parity you are mentioning about purchasing power or the inflation rate. So, suppose in example here US dollar is 53.50, Indian inflation is 8%, US inflation is there 3%. What will be the PPT after 2 years, purchasing power parity rate after 2 years. So, here same thing we have after 2 years E 2 will be current spot is current spot is 55, 50, current spot is 53, 5050, Indian inflation is 8%, US inflation is 3%, and we want to know the equilibrium exchange after 2 years to the power 2. That will give you after 2 years what is the purchasing power parity rate. Purchasing power parity rate, if you solve this, it will give us something around after 2 years rupee will be depreciating to 82.57. So, after 2 years if inflation continue in India at 8%, inflation continue in US at 3%, if the current spot is 535050, rupee after 2 years will be 588257. That is the rate of depreciation of rupees. Here inflation in India 8% and US inflation 3%, this 5% differential inflation lead to depreciation of Indian rupee, depreciation of INR, depreciation of INR or Indian rupee. So, this is purchasing power parity theory, the basic fundamental aspect of exchange rate determination. This generally used for the long run forecasting of exchange rate. In long run, it is not the interest rate, it is the inflation who get adjusted in the supply and demand of currency, and there will be depreciation appreciation of currency depending upon the level of inflation in two economy. So, purchasing power parity theory is a fundamental aspect of what is called the exchange and determination in the long run. In the balance of payment approach, we have discussed about in detail about the balance of payment. Balance of payment approach primarily determine the inflow outflow of foreign currency on the basis of two aspects. The balance of payment, when you consider balance of payment of a country, we have a two aspect. Balance of payment BOP has a two aspect, what is called, one aspect is called current account, another aspect is called capital account. In current account we have primarily export import, and also we have invisible inflow outflow. In capital account we have FI investment, FI, FDI and long term capital gain, long term inflow of outflow, gold, other things are there. So, this here the current account is day to day transaction of foreign currency. Here the supply and demand aspect of export imports are there. Countries more exports are more than import, we have current account, current account surplus, and export are export plus invisible receipt minus import plus invisible payments. These two we have positive, these two are positive, then we have current account surplus. Current account surplus occurs when exports are more than import and invisible payments are received are more than invisible payment. When we have current account surplus means we have a more dollar, more foreign currency than we demand. So, this lead to appreciation of domestic currency, and in an emerging economy like India, always our exports are less than import, we have current account deficit. So, our currency is depreciating, rupee against dollar is depreciating. Similarly, in capital account we have FI investment, FDI investment, some kind of foreign currency inflow in the long run. So, JDR, ADRs are there, these are inflow of foreign currency into India, and this inflow of foreign currency, suppose FI is a surplus, net FI is positive, net FDI is positive, we have net long run inflows are positive, then we have capital account surplus we have. In capital account surplus sometime help in appreciating the domestic currency. Then it depends upon the liberalization aspect. Capital account particularly depends upon the financial liberalization or foreign exchange liberalization. In capital account only possibilities are there whenever you have we have a good policy or FDIs are allowed, FIs are allowed to invest in India, the long term inflows of currency will be there. It depends upon the financial liberalization of a country. Here same thing I mentioned here, demand and supply of foreign currency reflected in current account and financial account determine the exchange rate, because the financial liberalization some extent determine a major determinant of foreign exchange rate. So, here in India if you see we have current account liberalization completely, our export imports rates are market determined. We have significant amount of liberalization in invisible aspect is payment and receipt of foreign currency. So, similar, but in the capital account some extent we have control. However, significant liberalization has been done in the FDI, FI investment, portfolio investments are allowed in India significantly, and this also help in inflow of foreign currency to India. So, same thing I have to mention here, current account of balance of payment or the export, import, services payment etcetera influence the exchange rate. Similarly, sustained current account deficit leads to depreciation of domestic currency. Sustain, when continuously our imports are more than export, our invisible receipts are less than our invisible payment, then the sustained current account deficit may lead to depreciation of domestic currency. Similarly, significant FI, FDI inflow also influence the exchange rate. Since we have significant FI and FDI inflow, we have significant amount of foreign currency reserve in India, which generally influence give a stability to our foreign currency market, and this may some extent help in influencing the conversion of rupee and into foreign currency, and that also provides stability to our foreign exchange market, and some extent the capital account have significant impact on the foreign currency exchange rate determination process. So, balance of payment, what you understand here, the balance of payment is the determine the supply and demand of foreign currency. The supply and demand of foreign currency comes from the current account side. Current account we have export, import, that determine the foreign currency movement at day to day basis. On the other hand, we have capital account determine the particular the FI investment portfolio side. The FI generally invest in stock market, in domestic in your debt market. Their presence in domestic market some extent also help in giving stability to exchange rate system in a particular country. Long run inflow of foreign currency in the form of FDI, in the form of foreign FI investment also leads to appreciation of domestic currency, and whenever there is a sustained current account deficit is there will be a depreciation of domestic currency, and this balance of payment, the variables of balance of payment, that is current account deficit or current account surplus or capital account deficit or capital account surplus, together provide some kind of environment which can influence the exchange rate system in a country, and these are the primary variable in demand and supply aspect of foreign currency and in determining the exchange rate in a domestic economy. Monetary approach, here we have to understand the monetary side of the economy. Monetary approach means when exchange rate, when foreign currency supplied to a domestic economy, the foreign currency converted into domestic money, the domestic circulation of money increases. When domestic circulation of money increases, that means that there will be more inflation in the economy if there is no control on the part of central bank. When the inflation is more as compared to US dollar, US or any other foreign country, then lead to depreciation of domestic currency. So, the approach is here, the money supply or the monetary approach here, money supply in the economy influence the interest rate in turn influence the inflow outflow of dollar. Second aspect is money supply, more money supply may create inflation in an economy, inflation in turn may also influence the demand and appreciation and depreciation of domestic currency. Here we understand the classical phenomenon of monetary approach. The classical phenomenon monetary approach is there when money supply, that is particularly called broad money supply M3, money supply increases. How to increase the money supply? When money supply, two way. First is you have to supply more money by reducing the interest rate. Domestic interest rate you have to reduce. When domestic interest rate reduce, there will be more demand of money will be there. There will be more demand of domestic money, because there will be more credit in the economy. Credit lead to supply of more foreign domestic currency in the economy. So, when domestic economy expanding, there will be it requires more supply of money. More supply of money possibilities are there, creation of demand. How to create more demand? You have to reduce the interest rate. When interest rate reduce, there will be more supply of money in the economy, domestic money in the economy. So, this lead to what is called decline of interest rate differential. Interest rate differential between India and US may decline, may reduce, because when the domestic interest rate decline, the differential available in domestic interest between two countries, that India and US here reduce, the inflow of dollar to domestic economy may reduce. The domestic economy inflow of dollar reduce, the conversion of dollar into money, that is a part of the money supply because of foreign currencies are coming to India, that may decline. So, there will be reduction of inflation in the economy, also possibilities are there. This inflation differential will increase. Inflation differential inflation differential between India and US may reduce also. This lead to here the nominal interest rate may decline, but real interest rate may increase. Real interest rate may increase. This may also create some kind of room for the movement, for the inflow of foreign currency to India. So, what does understand, what we our takeout from here is that domestic money supply some extent creates some kind of room for the determination of exchange rate. The domestic money supply, if there is more supply of money in the economy is occurring because of demand in the economy, the interest rate may come down, and interest rate when come down, there will be more demand of supply of money in the economy. When supply of money is more, it may create inflation, but since interest rate differential are reduced here, so there will be more room for the movement of foreign currency inflow to the economy. You have to understand here two aspects here, the M3 here two aspects. First aspect is domestic money supply. Another part of M3 contribute by FII or FDI inflow. So, when FII FDIs are inflowing, because it may because of this money coming to India, because Indian interest rate and US interest rate is positive. So, there will be more supply of more movement of inflow of dollar to domestic economy. When more inflow of dollar domestic economy coming, the dollar will be converted into rupee, and rupee circulation in the economy is increasing. This rupee circulation of economy increase, it may create what is called inflation in an economy. The inflation here we are considering nominal money, nominal interest rate, but when inflation in the economy increases, inflation differential, inflation in India minus inflation in USA, that difference because the supply of more domestic money will be further. When inflation is more in India, the real interest rate may come down, real interest rate differential may reduce. This real interest rate differential reduce, it leads to what is called less supply of FI or FDI investment in the economy. So, some extent the money supply through the interest rate influence, through the interest rate, through the inflation differential also influence the exchange rate side. So, we have to understand the exchange rate through the money supply, domestic money supply in the economy. Suppose this another concept you can understand here. Suppose M3 that domestic money supply, the government or the emerging economy in case of India, government want that there should be more supply of money in the economy. How the government will supply? Government will reduce the domestic interest rate. Government reduce domestic interest in the sense that RBI in case of India reduce the policy rate, the CRR, SLR or the your bank rate, repo rate, they may reduce this rate. Once the policy rate reduce, bank will also reduce the domestic interest rate. When domestic interest rate come down, credit uptake will be there. Credit uptake will be more in the economy. When credit uptake is more in the economy, there will be more circulation of money in the economy. When circulation of money in economy increases, it may create some extent short run inflation in the economy. Domestic inflation may increase. Domestic inflation increase. This lead to reduction of real interest rate. Nominal interest rate come down because of more circulation, government wants policy rate come down. At the same time, when more circulation of monies are there, inflation increase. So, real interest come down, significant reduce in the economy. Once the real interest rate reduce, the supply of dollar to the domestic economy may suffer. And this way the money supply, that is M3, through the interest rate, through the inflation also create some kind of determinant structure for the exchange rate in an economy. So, that also we have discussed in monetary approach, and another approach same thing also here provide how domestic inflation rate is equal to rate of money supply minus GYH is real growth, GNP growth rate, and GVH the rate of velocity of circulation of money. How the circulation of money in economy increasing, the rate of circulation of money, that will give us the domestic inflation rate. So, domestic inflation rate is influenced by rate of growth of money supply, the rate of growth of real sector, and also rate of growth change in the rate of velocity of circulation of money, that determining what is called inflation rate in the economy. And growth is domestic inflation is the supply of money is more and velocity of circulation of money is more, then there will be more inflation in the economy, and the inflation is more mean real money supply, real interest rate in the economy will decline, and this also influence what is called influence the exchange rate in the economy. Asset market approach, I have mentioned earlier, the asset market approach primarily consider the foreign exchange as asset, and its supply and demand through also influence the exchange rate movement. Here you have to understand there two things, the monetary policy and fiscal policy. The monetary policy, change in the monetary and fiscal policy alter the expected return and relative risks of financial asset, which in turn alter the exchange rate. To understand that, here one theorem is called Mundell-Fleming theorem. We are not discussing in detail. You can read any economics book on monetary or macroeconomics book on in the area of Mundell-Fleming approach. The Mundell-Fleming approach, there is intricacy or complex relationships are there between money supply, that is monetary side, and taxation side or government borrowing program, that is fiscal side. The monetary and fiscal policy together create some kind of environment where the exchange rate also affect because of that. The monetary side and fiscal side. Monetary side is here particularly the money supply, monetary side and fiscal side. These two together determining the Mundell-Fleming theorem, and the money supply and fiscal. Fiscal is government borrowing program, government taxation program, government taxation market borrowing program also influence the structure of interest rate in the economy. When structure of interest rate economy influence the interest rate again or influence the what is called the differential interest rate between two countries, and that determine the exchange rate. In the monetary side, the supply of money or demand for money along with the inflation and interest rate influence the exchange rate. So, monetary side and fiscal side together as a asset market variable that they determine the exchange interest rate, inflation, and along with that they influence the exchange rate in the economy. That actually I have discussed in the asset market approach. Asset market approach also some extent influenced by the economic integration. If the domestic economy is integrated with the world economy, the world inflation rate or international inflation rate, international interest rate, international inflow outflow of foreign currency some extent also influence the domestic policy parameter, which in turn also influence the exchange rate determination process. So, we discussed in detail about the interest rate parity, the forward point, forward rate differential, expected depreciation, there is a interest rate differential is positive, it lead to forward depreciation of currency, interest rate differential is negative, it lead to appreciation of domestic currency. That as part we have discussed interest rate parity hypothesis. Some extent there are also other parameter other than macroeconomic parameter, other than interest rate parity parameter, this is called technical side, technical analysis, that is the behavioral parameter. The traders are the main influencer, traders are the main influencer of very short term interest rate. Traders that take position in the foreign exchange market, their behavior, their approach to market also influence the exchange rate very short run. The traders here, if technical side, the candlestick models are available, technical analysis are available. Through the technical analysis side, candlestick model, they take position in the foreign exchange market, and their behavior, their expectation or the behavior also influence the very short term interest rate in the economy. Then here also, so in the asset market approach, there are other aspect also there, that is called relative interest rate hypothesis, capital market liquidity, a country economic and social infrastructure, the political safety, the corporate governance practices, the contagion, that is spread of crisis to different region, speculation, also this parameter some extent influence the exchange rate in the economy. So, exchange rate forecasting is a very complex phenomenon. You have to take into account macroeconomic parameter, you have to take into account the fiscal side, monetary side, interest rate side, you have to take into account the corporate behavior, traders behavior, you have to also take into account the international integration of domestic market, also some extent the behavioral parameters of the traders in a complex way you have to determine the exchange rate. There is no single theory which can help in determining the exchange rate. Many theories are there, all theories are complementary to each other, and together they can describe the some extent the actual movement of exchange rate. However, what will be the actual exchange rate, it is very difficult to predict. Exchange rate itself change very frequently, while the exchange rate market is a highly traded and highly liquid market, and these volumes trillions of dollars of transactions are there in a single moment, and there will be his market is highly liquid, and the expectation, the interest rate, exchange rate, interest rate, inflation, macroeconomic parameter, the fiscal monetary side and behavior of the traders together determine the exchange rate. You want to predict the exchange rate, you have to factor all these in our model, and nowadays people are predicting the exchange rate through different kind of model. The models are maybe deterministic model, the models are something a time series model, and these models are available in a different textbook. You can go through the model and understand how this parameter what we have discussed and they are helpful in determining the exchange rate in an economy. Now, references are there, same references whatever we have discussed earlier session in Resnick book and the Safiro book. There are foreign exchange forecasting site, some exchange discussed in detail. We can also Madura book, Jeffs and Madura, that is multinational financial management, discuss how the forward interest rate parity hypothesis help in forecasting the exchange rate, particular near future exchange rate. You can also read some books on monetary economics, some books on macroeconomic, how the macroeconomic parameter influence the exchange rate. Some model questions here. The model question I have framed some question in a long, you have to discuss in a briefly, discuss various approaches to exchange rate determination. Here you have to discuss all approaches, the parity hypothesis, you have to discuss the monetary approach, you have to discuss the asset market approach, you have to discuss what is called your that balance the payment side, and to articulate how the exchange rate can be influenced through this interest rate parity, export import side, balance the payment side, and monetary approach side. Outline various factors influencing exchange rate between two countries. When you consider two countries here, you have to take into account, articulate their, first to identify the factors. The factors are, you can segregate the factor into macroeconomic factor, that is interest rate, exchange rate, interest rate, inflation, growth rate, then some extent fiscal parameters, some taxation, they are borrowing, government's borrowing program, government controls on market. These are the factor which generally influence the two country exchange rate, and primarily the factors are here growth, demand and supply of foreign currency, and also the interest rate differential, inflation differential, and the forward movements of currency, because it may happen trader might have taken significant position in the particular currency. So, that also influence the domestic interest rate between two countries. Differentiate theories of exchange rate determination for short run and long run. Short run and long run, as we have discussed in long run is a purchasing power parity, that is the fundamentals in long run determination of exchange rate. In short run, it is the money supply, it is the demand and supply of foreign currency, it is the inflation differential, interest rate differential. These are the few determinant for the short run movement of exchange rate. Long run, it is only the purchasing power parity who decide the long run movement of exchange rate. It also you can consider long run particularly the financial sector liberalization program of particular country, and the country outlook for the coming outlook or sovereign risks, sovereign rating side also influence the long run movement of foreign exchange rate. Thank you.